Hello, welcome to the Brew. Today on the Lex Factor, we have a good buddy of mine, Eric Hale of Trader Oasis. This is an interesting episode. We're going to talk a lot of things. I'm going to let Eric explain these to you because he's got quite a process here, and I really want you guys to understand it. So let's get right to it after the opening bell. What's up, dude?
Listen to you, man. I love it. What's happening, my friend? How you doing? Looking good as always.
Thank you. You too. I love it. The Trader Oasis man himself.
Yes.
Yeah. You have a lot to talk about today. I know it. I'm excited about this one. And actually, you know what? In all honesty, you were telling me this pre-show. I didn't know you had 6 steps or 6 check boxes. I'm gonna let you explain it, but you have 6 processes that you like to follow before making the trade, during the trade, after the trade, all that kind of good stuff, right?
Yeah.
Awesome. Well, let's do this first. Let's tell the audience a little bit about you, because this is the first one we've done together for the hub. I think we're going to be doing a lot more. You and I work closely together. I've been on trips to various places with your community, which are awesome.
Vegas, baby.
Vegas, baby. You have a great community. So we do a lot together, and we talk a lot, and we share ideas on the platform, etc. So tell us about Eric Hale and about Trader Oasis and Options Animal. I don't want to get it all confused. I'd rather have you do it.
Yeah. So my name's Eric Hale. I've been a retail trader, but been involved in the education side of options for 20 years now.
Mm-hmm.
So my background is in engineering. I'm a math nerd. I love models. I love analysis. I love tools like that, which is one of the reasons why I love the platform, the Trader Oasis platform that we have for doing some really unique analysis around looking at trades and probabilities and what if happens when volatility changes and time changes and stock price changes, and also some of the advanced volatility data, looking at some of the dealer gamma stuff to try and come up with trade ideas. So I've been on this education side of the business for 20 years and actually sharing trades with clients, showing them what we have as a 6-step process, which I plan to outline here as to what that is. And, just let me pause here. The reason for the process is if you talk to anybody who's executing at a level of excellence, and I don't care if we're talking about brain surgery or a golf game, these people all have one thing in common. They all have a process. And having a process allows you to do several things. It allows you to get repeatable results. It allows you to determine if you're making mistakes, where could you have done things better. But probably one of the most important things is the ability to control emotions. So you know me, and I am not an unemotional person.
No.
I am swayed. My emotions are on my sleeve. And it affected me a lot in the beginner. You'd be very positive about something. You see a big spike up and you go chase it and then end up losing money. Or maybe sometimes you make money. What I found was that if I could get rational, really rational, follow a disciplined approach, my trading results increased dramatically. So that's the gist of it. So the company that does the education is Options Animal. You've heard of them. You know who they are. And we have a complete process at Options Animal. I work there a couple days a week, or a couple hours a week, actually, teaching students still. But most of my time is now spent here at Trader Oasis. And I don't know if you know this, but the OA in Oasis stands for Options Animal. And we just
did not know that.
You didn't know that?
No, I don't think I did. That's pretty cool, though.
Yeah.
So you spend time on both sides, right? So you said you train a couple days of the week on the Option Animal side. Now, on the Option Animal side, are those people actually making trades yet, or not? Are they still in the very early learning curve? What do you think?
Yeah, we strongly encourage those folks to paper trade until they're comfortable with the strategies.
Okay.
And let's all face it that we can. It's tough to paper trade, and that's really one of the important features. We wanted to make sure that paper trading was available in Trader Oasis for people, because they helps them get comfortable with the platform, but also understanding how different trades work.
Right.
I mean, you and I take it for granted. Most stock traders know they make money from one thing, and that is stock price going higher. Option traders who are sophisticated are able to leverage more than just stock direction. We leverage time and volatility as well, and to a lesser extent, dividends and the risk-free interest rate. But it's really those three big things: stock price, time, and implied volatility. And I always tell people that if you lost money or you made money and you don't know why, it was the volatility that changed. And for those folks who really understand it, and it takes some getting used to, especially somebody who's traded stocks for 20 or 30 years, options are a little bit different. So we encourage people to paper trade. Options Animal has an 8-step or an 8-level curriculum. There's about 5 or 6 classes per level. There's a test to get to the next level. And there's actually a guarantee that you'll be successful if you follow the process and get through. But those folks have always said, hey, where should I be trading? Where should I paper trade? And what brokerage should I use? And we partnered with a number of different companies over the past, 6 different brokerage companies in the past. And we've actually helped them build and launch some very well-known names that people have heard. We realized that nobody has exactly what we think our traders need. And that was why you and I have been together. I mean, it's been over 3 years that we've been working together.
It might be 4 now, man. We might be pushing the 4th pretty hard.
I think we are, because we've had the platform for over 3 years. So I guess 4 years now. And we've finally, got this platform to a level where we think that it has the most important features that retail traders need to be able to find trades, to execute trades, and more importantly, to be able to monitor and know when to adjust and keep track of whether you're making or losing money.
Right. I love it. So how long would you say it takes the average person to get through the 8 levels from Option Animal and I'm just going to call it graduate to Trader Oasis? So now they're really
there is
actively putting this together.
There actually is a graduation. There's a practical, people have to reset their account and be able to demonstrate an 18% annualized return over a series of trades in a period of time. So there is a graduation requirement. How long does it take? That's a good question. I've seen people make it through in 6 weeks, but I don't know that they really understood it. For me personally, I was a student. So not only am I the hair club president, I'm a hair club client too. So that's actually how I became an instructor. Is a little over 20 years ago. I went through this and really ate it up, and they said, hey, why don't you come work for us?
Nice.
So that was, I mean, really a fun opportunity, because my passion lies in this area. But it took me about 10 months to get through, almost a year.
Okay.
I zoomed through it. I cranked through it in the first 2 or 3 months, and then I hit a wall like a lot of people do. And going back to the question about trading with real money or paper trading,
right?
I can point to $14,000 in tuition, additional tuition when I was a student, in dumb trades that I made. In fact, I have a presentation where I walk through and it totals up to real trades that I did where I lost 14,000. Now, fortunately, I made some money too, so I wasn't net down 14,000. But some trades that I learned some real lessons on, and wish that I had paper traded until I understood those concepts.
Got it. Okay. Do you want to get into the 6-step process and look at an example? Is that a good idea, or what do you think?
Yeah, sure. Let's do that.
Okay. Do we need the screen right now or no?
Why don't we go to the slides right now?
Let's go to the screen.
Sharing the screen. So the first step that we look at is to determine direction. And most of the time we're thinking about stock direction. And that is important to think about. And there's really 3 reasons that cause a stock price to change. They're fundamental, technical, or sentimental. And as far as a weighting goes, I would pretty much give them an even third. So a third of the reason why a stock moves is because of something changed fundamentally, a third technical, and a third from a sentiment standpoint. But we focus a lot on stock direction, but we also need to remember there's three important things to think of when you're thinking about option pricing. The first is stock direction. The second is time. And Lex, I guarantee you, I'll bet my eyeballs you can predict time. Time's going to move forward, right? So time, sometimes it's so obvious we don't talk about it, but does that mean we always have to be theta? Theta is the Greek that tells us how our trades change when time changes. So do we have to have theta positive trades? No, but it helps. And if it's theta negative, then you have to make it on the other two things. So stock direction is delta. Time is theta. Implied volatility is vega. And if I think you know the answer to this, but if I held a gun to your head and said your life depends on it, you have to forecast either the implied volatility or the stock direction. Which one would you pick?
I would pick, and here's why. It's very simple. Okay, and I'm not saying this is right, but I would pick stock direction only because I wouldn't trade an option. Oh, no, I would. I take that back. I trade a deep in the money option because of leverage.
Okay.
And I would be in and out, and I'd be a day trader, and I'd collect my money every day. I'd rather have that ability, which, by the way, I did not have. I wasn't very good at stock direction, but very good at the options part of it. So, well, I'm not sure you agree with my answer, but that would be my answer.
No, I don't agree with your answer. But let me. I'm gonna throw a little.
Maybe we're gonna learn something new here. This is gonna be awesome.
I'm gonna throw a little bit of a curveball for you.
Okay.
I'm gonna pop up a screenshot here from CXO Advisory, and these guys took a look at a bunch of experts. These are people that you know.
Yep.
So you see Ken Fisher and Jim Stewart and Jeremy Grantham and all these people who do this for a living. And there's a significant number of forecasts that they looked at.
Right.
If you look at these accuracy numbers here, if you come down to James Dines and Ben Zach, they're right 50% of the time.
Oh, that's not good.
This is stock go up or stock go down. Okay.
Yeah.
So 50% of the time. But what strikes me is that these people over here, Bernie Schaefer and Peterman and here's Jim Cramer. He's right 46.8% of the time. And some of these other people down here, like Robert Prechter and the Elliott Wave, the guy's right 20.8% of the time.
Wow.
The stunning thing on this is that 2/3 of the people, and it works out to be exactly 67% of the people on this list, can't beat the flip of a coin.
Wow.
On determining the direction. Here's this. I'll just throw this out for those of you who are watching this. These people that are over here, they're mostly technical traders. These people over here, very, very fundamental traders. Some are technical, but they also look at fundamentals.
Yeah.
I would argue that if you had the choice between, and maybe I didn't do a good job asking the question, but if I gave you the choice of forecasting implied volatility, and this is NVIDIA. So this is the implied volatility chart.
Yep.
Where do you think implied volatility is going to go from here?
Higher.
You say up or down? Exactly.
Yeah.
Where's the stock going to go?
I have no idea.
Yeah, exactly. So I asked the question incorrectly. Implied volatility is much easier to predict. And
just so you were clear, when you asked me the question, I was assuming I was already an expert in stock direction. So that's why I chose that one.
Okay.
I was already well beyond 68% right. But anyhow.
Okay. And you might be.
No, I'm not. I'm terrible. I'm horrible at stock direction. I'm the worst. That's why I trade options.
See this blue line here. This is the implied volatility. I would ask, where do you think implied volatility is going to be out here in about 3 or 4 weeks?
Yeah, probably.
It's going to be up here, right?
That's another earnings cycle, right?
Right. And that's what drives. So understanding, I'm not saying earnings is everything, but I mean, implied volatility is everything. But you make money on changes in implied volatility. So why not look at it? And that's one thing that retail traders should be doing. Step one is make a prognostication on where you think the stock is going to go, recognizing that you're probably wrong. And we'll address that in a second.
Okay.
Also think about time and then think about implied volatility. And the answer is usually, I think implied volatility is going to go up. I think it's going to go down. I think it's going to go sideways, or I have no idea what it's going to do. And if it's, I have no idea, we can find trades that are vega neutral. So we can cancel out changes in volatility. But if we know in volatility, if we feel confident volatility is going to go up, we want a vega positive trade. If we think it's going to go down, we probably want a vega negative trade.
Makes sense.
So determining direction. The second step is to consider what possible trades could work. And we look at a host of trades, taking into consideration our delta, theta, and vega prognostications. And then the third step is selecting and structuring the strategy. So in the second step, we're asking, maybe I want to do counters or diagonals, or do I want to do like a stock-based strategy, a covered call or a collar trade, or maybe I want to do a credit spread. We all have our favorite strategies that we like to stick to. So we sort of brainstorm what sort of trades could work. And then this step 3 is an important structure or important step. This is where we go to the option chain and we look at strikes, we look at expirations, we look at premiums, we look at risk, reward, and probability in this step and see if, is this a good trade? I mean, somebody's maybe doing a credit spread that's $10 wide and it's a $1 credit. I mean, that's great. You're bringing in $1, you get $9 in risk. Maybe that's too much risk. Maybe I can look at structuring a different trade and get a better balance.
Let me ask you a question. In this step 3, this third step, do you guys find that most people gravitate toward multi-leg sort of spreads as opposed to naked options? Or do you just say, don't even try a naked option? What are your thoughts there?
Well, when you say naked, do you mean long or short or both? Or
I would say what I mean naked is a single option. You're either long a call, long a put, short a call, short a put. There's nothing against it, period.
Right. Sure. That's the same definition that I have. So we're on the same page. So as long calls are always a low probability trade. Long puts are too. So their probability of you making money on any long put. Now it does get much better. If you go deeper in the money, you can get closer to 50%.
Right.
But an at the money or an out of the money long call, they're a little bit like a lottery ticket. So you've got relatively low or moderate risk, and you get potentially unlimited payoff. You get very, very high payoff here. And I'm going to throw another one in here. There's a concept that I came up with at a seminar in Hawaii. Actually, we were doing this presentation. And if you think of option trades, and I call this the purple nacho, just because it happened to be purple. And I was talking I was saying, well, you're on the purple nacho. And part of the reason I mentioned nacho is because this is a really pretty triangle. In reality, it's really got nooks and crannies and hard to get in the corners like a real nacho.
Right.
But if you think of all trades as this context, you've got a dial for probability, you've got a dial for profit, and a dial for risk. And you can only get 2 good ones. So with something like a long call, you have unlimited upside and moderate to low risk. And therefore your probability is going to be low. If you want to dial up the probability, I want to get better probability, you either have to take less profit or more risk. So with a naked call or a naked put, they are very simple. There's something to be said for that. But long options tend to have the odds stacked against them because, like I said, they're like a lottery ticket or a scratch and win where you've got unlimited upside. And so I think if you enter into one of those trades, you need to recognize the odds are you're not going to make money on it.
Right.
So the next step, which we haven't talked about in our process, is actually your exit plan. So what are you going to do when you don't make money? I think it's okay to do a long call or a long put, recognizing that the odds are stacked against you. So you have a clear exit plan. If you make money, you take profit.
Yep.
If you don't make money, you have a plan for how you could fix that. And your exit plan could be, when I'm down 20%, I'm just going to cut, I'm going to cut bait. Or maybe you could look at, I could take that trade and maybe I could adjust it into some sort of a spread trade, maybe a credit spread or a debit spread or a calendar or a diagonal or some other strategy. And that secondary exit is really where this is the most important part of our process here, is determining your exit plan. And this is really what helps traders control emotions, is being clear on what am I trying to accomplish here? And when I hit that target, which could be a profit goal, so 20%, 50% return on risk, or it could be a date after earnings. I'm going to close for any profit. when the Fed announces, or before the Fed announces, I'm going to close the trade for any profit.
Right.
Or it could be a price target when or a technical signal. When
Mm-hmm.
the MACD crosses over, I'm going to close the trade for any profit. So being clear on what your exit plan is, both for when do I take profits, but the second part, and this one, your exit plan, like you talk about buying long calls. And somebody here is probably thinking, oh, great, I'll go buy a long call on NVIDIA that expires in 2 days on Friday. That trade, your exit plan is to lose money because you're not going to do any. So by the time you realize that trade didn't work, we're talking Thursday or Friday, there's no sort of adjustment that you can make.
Right.
And so when you're in this process isn't necessarily 1, 2, 3, 4. It's a little bit like dialing a phone, the old rotary phones, you remember, right?
Yeah, sure.
So you do 1, 2, let's pick a trade. Let's structure it. Okay. We like the structure. We like the risk, the reward, the probabilities. Let's talk about our exit plans. Nah, we don't like the exit plan. Let's go back and pick a different trade.
Right.
So it's this iterative process. And then the most important point to note is that placing the trade is after you've defined your exits.
Oh, I like that. That's good. So let me ask a question about the defined exit. Is this a situation where you encourage people to write these down? And
100%. 100%.
Okay.
So,
and if you could automate the process of your exits, that's probably even nicer, right? That'd be more wonderful.
That would help to minimize your risks. If you could have an automated exit plan that when the certain profit is hit, you've got a good till cancel the order and the order gets filled. Gotcha.
Okay, great. So you determine all this first, then we go to step 5, which is make that trade.
Right. And when I was a trader, initially I'd say, well, Options Animal has these resources for figuring out how to adjust trades. I'll go figure out how to adjust it later when I got in trouble. And so one of the questions that you mentioned earlier about naked options, a very popular strategy is the naked short put, or some people call it a cash secured put, with the intention that they're going to buy the stock. And that's all well and good until you get some of these massive drops that we've seen where, look at what happened with Dollar General here just a few weeks ago. The stock just crashed down. And this is one that I was actually trading. Let me turn off the volatility here. You got the stock trading at 125 and it dropped down to 84 overnight. And
was
if you
that
have
an earnings play, Eric?
What's that?
Was that on earnings or was it just something else?
Yes. Yeah, it was on earnings, but the move was way, way bigger. The expected move, I think, was 115. So when you looked at the option pricing, the expected move, it moved way, way, way more than anybody anticipated. And these are the kind of trades that, I used to do naked puts. I used to do cash secured puts. These are the kind that are like career-ending events. The people who experience those sort of losses, they're not around to share their stories. So you hear about survivorship biases. I did it. It worked. Right. Therefore, I must know what I'm doing. And if you do a naked put, you're probably in the 80% probability of making money, maybe 70%. And the fact that are you going to take a massive, like a 50% or 40% haircut overnight and be down thousands? These don't happen that often. They're pretty rare. Right. There's we look at these probability models that we have in What If, and if you just pop any trade in there, it comes up with a probability.
And you like to look at that probability, right?
I do, but you need to keep it into context. George Box is a famous statistician. This is a model. George Box, the statistician, said all models are wrong. Some models are useful. So this model is wrong. These probabilities are, you got to take them with a grain of salt. When you start getting into probabilities that are like 80%, they might actually be 90, or it says it's 90, but it's actually 80. And you say, well, 80% or 90% are close to each other, but you really need to inverse it and look at the other way. If I have a 90% probability of something working, that means there's a 10% chance of it not working.
Right.
But because of option pricing and liquidity issues, it might actually be 80%.
Right.
And so the difference between 80% and 90% are close, but look at the other side. The difference between 10% and 20% is huge.
Right.
And so these losses, what happens is we tend to get these mega moves, these like 3 sigma, 4 sigma, 5 sigma. I've seen 6 sigma moves. To put things into perspective, you should see 1 4 sigma move in your entire trading career. You should see it happen once in about 45 years of trading. You should see 1 4 sigma move. The truth is you'll see 1 or 2 a year. And sometimes they're on the upside, sometimes they're on the downside. Sure. If you're caught crosswise on those, so you got to be careful with the probabilities and take them with a grain of salt.
Sure.
And anything that's way, way out on the fringes. And that's where people who are doing naked options, like the one strategy I'd never do is a naked call. And you look at this trade, say, hey, you got a 65% chance of breaking even, and even if it goes up to say 130, I'm only down $400 or $500, but you could get something that happens, like somebody announces NVIDIA, I don't know, cured cancer or whatever. The next thing, can you imagine NVIDIA at 200 or 180? Yeah. Right. So you make $380, but now you're down $5,500. And I've had clients who've come to me and had life altering moves. And I mean, you know me, I'm a big empathy guy. I care a lot about everybody, care about you, care about my clients. And when I find that somebody, one guy came to me, he said he was doing so well selling naked puts. He's a dentist. He sold his business. And he said on the Thursday before he was retiring, he lost so much money on naked puts that if he wasn't retiring, he'd have to work 2 more years. He lost that much in a day.
No fun.
Yeah.
I know those stories from my past. I had one myself. Wasn't fun.
So for me, I'm a big fan of a bull put over a naked put, and we should make that another topic, because I can convince, if I spend enough time with anybody, a bull put is a far better trade.
Oh, I agree.
And arguably better, because you can get higher return on risk. You can get higher probability. You can win more often, and your ability to adjust the trade is so much better. So even objectively, now the beauty of a naked put or a cash secured put is they're really simple and they're not complicated. But when you've got a long and a short together, you got more moving parts. I'd love to spend some time, because I have convinced people who were regular naked put sellers that you can make more money, win more often, and have lower risk. And those are 3 good things to have. And any one of them would be the reason.
Yep. Yeah. We'll talk about one of my stories in another episode, but I want to get to number 6 here.
So number 6 is just monitoring and staying on top. And a big part of this is when we close trades and make any sort of adjustments, we need to keep track of our cost basis. And that's a big, big part of the Trader Oasis platform, the strategies feature, why we push so hard to have that in there, because it allows you to keep track of your cost basis. And I'm not talking about cost basis. The example that I'm using here is if you had an apartment building that you rented, or a house, and you paid $10,000, or let's say you paid $100,000 for it, and you rent it out for $1,000 a month. So at the end of the year, what do you own that building for? So you paid $100,000 for it, and that's what the IRS looks at, your cost basis. But you generated $1,000, so your actual net investment is $88,000. So keeping track of that cost basis, where your risk and reward is. You've got a bogey, and it allows you to manage trades and make sure that you're consistently making money. And having that feature in Trader Oasis, for me personally, has easily doubled my results. I can trade twice as much, and my results have been much, much better.
Good. Yeah, you were adamant about that feature. I will remember that. So we're going to take a look at the 6 steps in action in a live episode on the next episode of the Tranquil Trader with Eric Hale. How do you feel about that? Was that cool?
I love it. I think it's fun. I love doing this. It's a lot of fun for me, and it's my passion.
Well, I can tell you are passionate about it. You're very good at it. You're a great teacher. I think we could do a number of these too. So I'd like to really get into your brain on how you adjust these ultimately and when to take them off, take the money and run, how to massage it a little bit more for maybe a little bit more coin in the pocket. So we're going to look at all that in episode dose. What do you say?
Sounds awesome.
All right, buddy. Thanks for coming on. We'll do it again.
All right.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.